One of the things we're doing that I like is we're a 10-year hold. So while a lot of people love the idea of doubling their money in a couple years, and that's great when you can do it, but the 10-year hold is allowing us to relax and not be so concerned about the cap rate, expansion, interest rate, ups and downs, and all that.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today is Paul Moore. He's founder and managing partner of Wellings Capital, 17,000 plus self-storage units, manufactured housing, and multifamily units, over $500,000 in assets under management. Has a degree, an MBA from Ohio State, entered the management development track at Ford Motor Company in Detroit. After 5 years, started a staffing company with a partner, sold it in 5 years, began investing in real estate in 99. He's 85 plus real estate investments and exits. He's appeared on HGTV, House Hunters, and a number of different places. And Paul's been a friend of mine for many years, which many of you may know. You'll hear us talk about it a little bit, but he's going to share some insights to actually the next 2 days that I know whether you are active or passive, you're going to learn a lot. Paul, it's always a pleasure to connect with you. You're somebody I've known for long before I ever got in the syndication business. You and I were playing music together. Listeners probably don't know that, but they should know it. And so grateful for having your time and having you on the show. Congratulations to your success. I'm looking forward to diving into a few topics today, actually over 2 days, a series of shows, and highlighting some expertise you've gained and sharing it with us. Thank you so much. Welcome.
Oh, it's great to be here, Whitney. Thank you so much. And yeah, people don't know that. I mean, aren't you like, didn't you study under Neil Peart to like the greatest drummer of all time?
I'm still giving his family lessons for his son, and I'm just kidding.
Okay, great.
No, not at all. Not at all. No, I do enjoy playing drums, but I've never claimed to be that good.
Okay. Well, I think you really are. So,
oh, well. I appreciate the kind words. Well, Paul, you have pushed forward in many ways with Wellings Capital. I know we've had you on in the past, but it's been a bit. Give us an update on what's happening, or maybe what's happened most recently with Wellings and your all's focus, and then let's dive in.
Yeah. So Wellings Capital, just kind of a background here. I wrote a book called The Perfect Investment, humble title, back in 2016 about multifamily investing. And then I got really concerned. I really felt like that, honestly, our team did not have a great acquisition strategy. We weren't finding off-market deals. We were competing with people who honestly were willing to overpay, over leverage, and do all kinds of things that just kind of drove the prices through the roof in a lot of cases. And a lot of multifamily investors were doing a great job, but the some who weren't doing such a great job made it really hard for us. So we expanded into other asset types back in 2018. We added self-storage, then mobile home parks, RV parks, light industrial, open air shopping centers, still doing multifamily. Whitney, you know that I read the book, The One Thing by Gary Keller and Jay Papasan. And I realized we can't be an expert in, I'm not sure we'll be in the top 10 or 20% of multifamily ever, but we'll certainly not be a top operator in 4 or 5, 6 different asset types. So we decided to pull back and become a fund manager. And our goal was to go out and find suitable investments from top operators in these different asset types. So that's what we've been doing for years now. We're on our 6th fund. And we've raised about $127 million total. And about 40% of that or so is in this current fund. So we're having the time of our lives doing this and really enjoying, even though it's a tough time in the commercial real estate realm right now, we're still doing the same thing we were before. We're investing with operators who often find mom and pop deals off market. And by finding those types of deals, they're sometimes getting owner financing, or sometimes they're paying cash, and they're able to make significant operational improvements to increase the income and hopefully to maximize value to investors. So one of the things we're doing that I like is we're a 10-year hold. So while a lot of people love the idea of doubling their money in a couple years, And that's great when you can do it. But the 10-year hold is allowing us to relax and not be so concerned about the cap rate, expansion, interest rate, ups and downs, and all that.
Love that. I also like the longer hold periods like that. I've heard a few operators talk about, man, just the bliss almost of having a 10-year hold, right? And you can weather those ups and downs, right? It's so much easier. So I love that. So, but you all are focused in a big way on a specific asset class now, right? I mean, or I know you talked about you all are partnering with some specific operators, finding those mom and pop deals, but is that a specific asset class, or are you still doing some of different things?
No, we're doing all those 6 asset
Okay.
classes I mentioned. In fact, we're even diversifying not only across operators, geographies, asset classes, strategies. We're also now diversifying inside the capital stack. And so we're actually doing a little bit of debt, a lot of common equity, but we're also doing preferred equity right now. And hopefully we'll get a chance to talk about that sometime.
Yeah, of course. Let's do that. Let's jump into what that is and even why that versus debt, or the different types of things you're doing, why you would consider one or the other. But then I want to dive into the preferred equity and what that is exactly. But talk about those three things kind of high level a little bit, and then let's specifically dive into preferred.
I sounded so sarcastic when I said hopefully we'll get to talk about that sometime. I forgot we were talking about that on today's show. I thought we were talking about RV parks. So anyway, I was being silly. But yeah, so we as a fund, we're investing in other people's deals. And so we're coming in as a large LP investor typically. So usually we're often getting better terms. We're often getting access to deals that they don't even go public. Some of them, like I'm thinking of a couple self-storage conversions near Boston. They didn't even hit the public at all. They just went to friends and family. We were one of those friends. But there's always a concern that investors are thinking, well, I don't really need you. I can go straight to the operator. And I'm thinking of another operator, a self-storage operator in West Palm Beach, Florida, that has a $5 million minimum. So most of our investors couldn't get into that. But I can tell you for sure that I can't think of any way for an individual investor to get into preferred equity unless they're doing it through a fund or another operator. Can I show you a picture of preferred equity just to give you an idea what I'm talking about?
Please. And just so the listeners know, you can see this video on YouTube, but Paul's going to talk through it in a way too that if you can only listen, you'll still understand.
Yeah. So imagine a capital stack that has debt and equity. So the bottom of the one I'm looking at here has 60% senior debt. And you would expect that the top would have 40% common equity. And that's what a lot of deals look like, something like that. But right now, a lot of operators are finding that it's hard to get as much debt as they used to. They might have expected to get 75 and raise 25% in common equity. But now they're getting only 50 or 60% senior debt. That might be constrained by the debt service coverage ratio. It might just be because the banks are tightening their standards. And if they're only able to raise the 25% common equity that I mentioned already, that's leaving a 15% gap in the middle. Now, that gap can be filled by either mezzanine debt, or which would be like a second loan, a junior loan, or it can be filled by preferred equity. We really like preferred equity. And there's a lot of reasons for that, but I did want to show this. So again, if you're listening, imagine a 3-part capital stack instead of 2, the bottom being senior debt, the middle being preferred equity, and the top being common equity. And of course, the top, the common equity, that's actually at highest risk, as it always is, in case there's losses. But of course, that is the place of highest gain in an asset that performs as expected or profitably. So we really like preferred equity because, first of all, it provides immediate cash flow, just like debt, has a future upside, just like equity, and a shorter hold time. And at this point in the cycle, a lot of people are a little nervous about the long hold times that I mentioned earlier. It has payment priority ahead of common equity. So if in the example I use with 25% common equity. If the cap rate expanded or net operating income dropped and 25% of the value was wiped away, that would all be in the common equity realm, in that example at least. And so the preferred equity would still be made whole, as well as the lender. There's no lien, that's a benefit of senior debt. There's typically a lien on the property. But in this case, sometimes we're often getting personal guarantees from the sponsors for this. There's lower downside risk exposure than common equity, like I mentioned. We still negotiate depreciation benefits. We still get paper losses from depreciation passed through to us. In fact, in one case, we got 100% of all the depreciation because the operator didn't care about it for some reason. We can negotiate control rights in case something goes wrong. We can negotiate forced sale rights. We can be recognized either officially or unofficially by the lender, like Fannie Mae or Freddie Mac. And what that could mean, that forced sale provision especially, could mean that the lender wouldn't foreclose if there was a problem. They would allow us to force a sale and make sure we were made 100% whole in the sale. So that's some of the benefits of pref equity in general. I'll take a breath, Whitney.
Yeah, no, that's great. I just appreciate thinking through that. Even seeing the slide, I would encourage listeners to see that. I think it's helpful to see the visual there. However, I think Paul laid it out there from senior down at the bottom. You think the higher you get on a ladder, the riskier it is, right? So
right.
As you go up, but maybe just on an elementary note here on this for our maybe newer passives or actives, who are the investors that are in the common equity versus the preferred equity, and how would they be in one or the other?
Yeah. So typically some people, by the way, think this is, they think, I'm an investor in a certain deal. I get preferred because there's a preferred return of 8%. That's not this. This is something completely different. So this is closer to a different type of equity. Well, it is a different type of equity. It's closer to mezz debt, like I said. But if the LP, so in the deals in pref equity we've invested in, the LPs in one case were a bunch of LP investors, just like you would typically see. And in another deal, it was actually the sponsor equity. Everything behind us or above us in the capital stack is actually, it was 25%, I believe. It was all GP equity, so their own skin in the game, which we thought was even safer. And so that is typically where the LP money is coming from. I want to point out too that there are at least three types of preferred equity. There's probably more. One would be development, like somebody's building a building and they've got so much potential upside that the high cost of preferred equity, I didn't mention that yet, but the high cost of preferred equity right now is definitely within their budget if they make a big sale. Another type is rescue capital. There's a couple kinds of rescue, but I'm just going to go with the most obvious one, and that is a deal's in trouble. They've got to pay for new rate caps, and it's really expensive. They've got to refinance, and the new loan is going to be a much higher interest rate. So a rescue capital might be somebody who comes in and says, okay, we're going to give you egregious terms, and we're going to possibly have forced sale rights. We'll take this over, and if it goes bad, we're okay with that. And so that's not what we're doing. And we're also not doing development pref equity, though I think that's a fine thing to do. We're doing the third type, which is acquisition equity for the most part, not exclusively, but for the most part, we're doing acquisition equity, which would be buying a value add deal. And for the operator, it's a great benefit to have this because think about it, back in my capital stack, if there's a 15% pref equity in the middle, they could refinance and take us out, or they might have, maybe the GPs have profit from another deal they're about to close on. And when they do, that cash will come in and potentially take us out. And then they can buy that effective 15% of ownership, which could potentially maybe even double the GP's stake in the deal. And so it's really good for everybody if it's done right.
Yeah, I think it's so helpful to think about it that way. I appreciate you laying out a few different types there. We've heard often lately about this rescue capital. A lot of people are talking about creating rescue capital funds and whatnot as well, because I think there's definitely going to be a need for that more and more, unfortunately. But on the acquisition side, you said most of the time that's what you all are doing, value add types of deals. Are there other types of deals that this would be considered for?
Yeah, another one would be one we're looking at right now is a 5 park portfolio, mobile home parks. One of the deals, they're all funded individually and they all have their individual debt on them, of course. Most of the debt's going to be like 4 or 5 more year term. But one of the parks is the debt is coming due. It's terming out in like March. And so they're talking to us about possibly coming in with pref equity when that debt's gone, just to be the only, in other words, we would be in first position in that case. We would just be, they'd have pref equity and common equity only, or possibly GP equity on that deal. So that's another type. Another one would be for an existing operation that doesn't necessarily need rescued, but they really want to have some working capital to either go maybe buy more land next door. Let's say it's an RV park that wants to acquire an extra 100 acres next door. And so they might use pref equity to do this, and then they would refinance us out in 2 years. Or it could be a multifamily operator who has a fabulous history of value adds, but they don't have any extra cash available right now. And they want an extra $3 million, let's say, to do value add on 100 or 200 more units. And that money would be, again, likely refinanced out in a couple of years.
What are some of the downsides, Paul, or even better, what are some of the things that an investor that's considering even investing with you all in this fund should be asking an operator or fund manager like yourself, knowing that this is the piece of the stock that we're investing mostly in?
Yeah, I mean, I think I get a lot of comments on Twitter where people are like, wait a minute, isn't this rescue capital? Isn't this just throwing bad money after bad, or good money after bad, I guess? Or isn't this a dumpster fire followed up by, they use all kinds of words on there, and that I won't repeat. But at any rate, that's just not, like, that's something I would definitely ask. I would also ask to make sure that the person before you invest, that if they're coming in behind Fannie Mae or Freddie Mac, that it's coterminous with Fannie or Freddie, and that Fannie and Freddie's going to approve them. Make sure they've done all the due diligence that you would want to see. We've actually 2 or 3 deals in a row, one at the closing table. I mean, literally at the closing table, we'd already wired money we pulled out of because of just last minute shenanigans by the operator that we weren't willing to tolerate. I mean, don't, just because it's in a safer place in the capital stack, you still want to see all the due diligence you would anytime you make any investment. Truly, it's likely that it's less likely to lose money, but it still could lose money. I mean, if the deal goes south entirely, there's a lot of things to look for. One of the things we're doing right now is so there's a lot of folks actually out there wanting to do preferred equity, and most of them don't want to mess with it under $10 million. So a lot of the shops out there, as they're called, or investment funds, they want to go from 10 to, let's say, 100 million. And after seeing the amount of due diligence and legal structuring and work and NOI audits and everything else that's going into this, I'm talking a lot of work and a lot of money spent on legal. I can see why they want to be at 10 million or above. But we're looking for deals in the 2 to 7 million range. And the reason is we can get a much higher coupon. There's so few people out there wanting to do this right now. I mean, we're seeing coupons 10%, 9 or 10% current pay, plus another 5, 6, 7% on top of that. So we're seeing total coupons in the 15 to 18% range. That won't last forever. I mean, that's partly a function of the fact that interest rates themselves are so high right now, and lending has tightened up right now, and there's so few people wanting to do pref equity. And if they've got a really good team and a good plan and a good track record of upgrading these deals and making these value adds really work, well, they can confidently say, hey, it might cost us 16% for 2.5 years, but we'll be out and then we'll acquire that or we'll distribute it among the whole equity investors, depending on how we go about taking the pref equity people out.
Yeah, definitely some benefits in managing a fund like you have, where you can negotiate. You have more negotiating power, right?
Mm-hmm.
When the capital's there, you can go to somebody and say, "Hey, we got the 7 million you need tomorrow if everything checked out," right?
Right.
Yeah, so that's helpful for investors. I mean, they may not know the exact deal up front, but they know that, man, that's giving you so much more power and giving them more benefits by having that all up front. No doubt about it. Anything else about the pref equity that people are asking about, Paul, or that maybe you've got questions about? I mean, from investors that you want to share before we end this segment?
Yeah, I mean, one thing that people would ask is, somebody on Twitter blasted me and they said, I just reported on a deal. And one of the deals we did was the kind where we were actually providing additional capital for them to go out and buy more or upgrade some value add. And we got personal guarantees from two brothers with a combined total net worth of $300 million. And they were the only capital in these deals. There was no LPs. It was all capital. It was all GP capital. And they paid us 15%. And that was like, rather than split it into 10% current and 5% upside, they just said, we'll just give you 15% right up front. And they gave us a whole year in advance. And so at closing, instead of giving them 5 million, rough numbers, we only gave them 4.5 million because we kept the $500,000. I didn't do the math right on that. I just realized, but we kept the rest, the whole 15% of 1 year. So we just kept that $750,000 in our bank account, and that's now earning money in treasuries, and we're feeding it out 1 month at a time out of this reserve account into our fund. Well, somebody on Twitter blasted me and said, there's no way. This is ridiculous. This is not true. Nobody in their right mind would do that. And that's a question we get. Why would people pay so much? Well, honestly, the most successful real estate developer I know personally, I mean, he does like 8,000 lot subdivisions, seriously, like at Myrtle Beach and in that area. Like, this guy is the boss. He sat down with me recently for lunch and he said, I am done with lenders. I said, what? He said, I've been working with this lender for 23 years. Our kids are friends. We're friends. And they just totally tightened the screws down on me. He said, I would rather work, and this was a bank, I shouldn't say with lenders. He said, I would rather pay 2 or 3 or 5% more to a private. I would rather pay hard money rates to a private lender that didn't treat me this way. And in fact, he since did that. He actually went out and found a private lender. And so that's part of the draw here. Banks, when they tighten down, sometimes they have requirements. Sometimes they have reserve requirements. My son, who you know, is doing real estate deals where they're asking him now, like one of the banks is saying that he should put 10 or 20% of the loan amount in cash in a bank account. He's like, wait, I'm just going to leave it there in a bank account and not use it? Yep. Well, they're just sick of this stuff. And so they can do a lot more, and they can be a lot more flexible with pref equity or private debt than they could going through a bank. And that's one of the reasons they would do this. I will point out one more thing. This opportunity is not going to last forever. When interest rates go down and when banks loosen up again, the pref equity opportunities we're seeing now will probably not be here. At least they won't be as profitable as they are now.
Yeah. Yeah. No, I think it's an interesting point to think about, that a developer, somebody like that, would pay more, right? But it's more for the flexibility, I think, and the knowing that there's not going to be some kind of requirement like that up front, right? And maybe get draws on time and with less requirements or things like that could delay a process. You think you're getting a better interest rate, but man, if it delays you 6 months to get the money, that's a problem, right, for a developer. So, Paul, grateful for your time and just laying out, man, what is a preferred equity, the capital stack? Where does it live in there? Some questions that investors often have about this type of investing, some pros or cons, whatnot. Tell the listeners how they can get in touch with you. And before you do, we'll remind them, hey, Paul's going to be back for another segment tomorrow. We're going to dive into another topic he's definitely an expert in. Paul, where can they find you?
They can follow me on Twitter at Paul Moore, Paulmoore, at Paul Moore Invest, or they can get more information on pref equity or many other topics at our website. It's wellingscapital.com. That's WELLINGS, wellingscapital.com. And if they want to do wellingscapital.com/resources, we can get them a free special report on all kinds of different topics.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.